Welcome to the deep dive. Today, we are taking a really specific look at Roku, a big name in streaming, obviously.
That's right. And usually with these tech companies, everyone talks about the gadgets or the shows, right? But today, nope, we're diving straight into the finances.
Exactly. We've got the Q3 2025 earnings call transcript, but we're zeroing in. Just the prepared remarks from the CFO and COO, Dan Jetta.
Yeah, skipping the CEO intro, bypassing the Q&A. We want the raw financial story as he laid it out.
Our mission here is pretty focused. We want to pull out just Jetta's overview on their financial health, their capital strategy. For you listening in, this is kind of the direct line to understanding how they see their own financial discipline right now.
We're looking for those key numbers, the signals that tell us about, efficiency, profit, and how confident they feel about the future.
And the message seemed pretty clear, didn't it? Like they've hit some kind of turning point.
Oh, definitely. It wasn't the usual growth story. It was much more about, okay, we're becoming a financially solid, sustainable business now. Profitability is the focus.
Right. So let's start with the foundation then, the balance sheet. What kind of cash are they actually working with?
Okay, so Jetta kicked off with that, and it's strong, really strong. They're sitting on $2.3 billion in cash and short-term investments.
Wow, $2.3 billion. That's a serious cushion.
It's huge. It gives them massive flexibility, right? They're not desperate for funding. Even if the market gets choppy, it lets them be strategic.
Okay, so the cash pile is big, but that's just, snapshot. The bigger shift is how they're making money. What was the main headline operationally?
The big one. Positive operating income in Q3.
Positive operating income. Okay, break that down. Why is that specific metric such a big deal compared to, say, adjusted EBITDA, which we hear about more often?
Well, operating income is kind of the cleaner number. It's profit from the core business operations before you start adding back things or making adjustments. It shows the fundamental business, selling the hardware, running the platform, is actually profitable on its own.
So it's harder to, let's say, financially engineer a positive result.
Pretty much. It's a tougher benchmark. And the context Jetta gave was crucial. He said this is the first time they've hit positive operating income since way back in fiscal 2021.
Yeah, since 2021. Okay, that really puts it in perspective. That's not just a blip. That suggests a real structural change.
Exactly. It shows that all the talk about cost control and efficiency over the past couple of years wasn't just talk. It's actually reshaped their financial reality. They've made that tough switch from just chasing growth to generating actual profit.
So the message is the growth at all costs phase. Officially done.
That seems to be the signal, yes. They're scaling now, but scaling profitably.
Okay, building on that Q3 success, what about the outlook? Because the Q4 forecast, that seemed ambitious.
Yeah, ambitious is a good word. They are forecasting what Jetta called a high watermark for profitability.
Which translates to?
An outlook for Q4 adjusted EBITDA of $145 million. And he specifically pointed out this is their highest ever adjusted EBITDA forecast.
Highest ever. Okay, so they're not just profitable, they're forecasting record profitability.
That's the projection. It sets a completely new expectation.
But one record quarter is one thing. What about the bigger picture, like full-year efficiency? Are the margins getting consistently better?
Yes, and the full-year numbers back that up. They're expecting full-year EBITDA margins to hit around 8.4%.
8.4%. Is that good? How does it compare?
Well, the key thing Jetta highlighted is the improvement. That 8.4% represents a 200 basis point improvement compared to the previous year.
Okay, 200 basis points. Remind us, what does that mean in simple terms?
A basis point is just 1/100%. So 200 basis points is a full 2% improvement in their profit margin over the year.
Right. So for every dollar of revenue, they're keeping 2 cents more as profit compared to last year. That sounds like serious efficiency gains.
It really is. It's not just trimming around the edges. It points to, fundamental improvements in how they operate, finding 2% across the whole business.
And they don't think they've maxed out on that either.
Apparently not. The CFO mentioned they anticipate similar improvement in EBITDA margins for next year, for 2026.
Okay, so they see more room to run on efficiency. It sounds like this focus on cost control is now baked into how they think.
It seems so. And it links directly to something else he emphasized. Their approach to spending, particularly capital expenditures, or CapEx.
Ah, yes, the CapEx light comment. What does that mean for a company like Roku?
Jetta said, we are and will continue to be CapEx light. Basically, it means they don't need to sink tons of money into physical stuff, factories, massive server farms, big infrastructure projects that constantly need upgrading.
Because their business is more about the platform, the software.
Exactly. That scales differently. It's generally higher margin and needs less physical investment to grow compared to, say, a manufacturing company. It makes their financial model much more, well, light.
And being CapEx light should directly translate into better cash flow, right? If less cash is going out for big investment.
Precisely. And that's what they reported. Free cash flow is actually growing faster than their EBITDA.
Faster than EBITDA. How does that work?
Well, if EBITDA is growing nicely, but your capital spending is staying flat or even shrinking because you're CapEx light, then the cash lift over the free cash flow grows at an even faster rate. It's like getting a raise but also cutting your expenses. Your savings grow super fast.
Got it. And what was the actual number?
The trailing 12-month free cash flow was over $440 million.
Over $440 million. That's a lot of cash generated internally.
Very strong. And that cash becomes incredibly important for the next part of Jetta's remarks, how they handle their stock and try to boost shareholder value.
Right, because all this profit and cash flow is great, but if the number of shares keeps ballooning, existing shareholders don't benefit as much. Dilution.
Exactly. Dilution is always a concern with tech companies paying employees partly in stock. So Jetta laid out their strategy, the main goal: maximize shareholder value through disciplined capital allocation.
And how are they tackling that dilution head on?
Two main ways. First, something systemic. The net share settlement program they started back in early 2024.
Net share settlement, what does that do?
So when employee stock awards vest, instead of just issuing brand new shares to cover them, which increases the share count, the company uses its own cash to pay the taxes owed on those shares.
Ah, so they use their cash buffer to absorb some of the impact, preventing some new shares from hitting the market.
Correct. And Jetta gave a figure. He said, this program is already offsetting about 40% of the gross dilution. That's a big chunk handled automatically quarter after quarter.
40% offset just from that program. That's significant. What was the second piece?
That was more opportunistic.
So
Share
opposite.
repurchases, they were active in Q3.
How active?
Very. They bought back $500 million worth of their own stock.
$500 million. Wow. Was that part of an existing plan?
It was, but here's the interesting bit. It was executed under their announced $400 million share repurchase program.
Wait, they were authorized for $400 million, but spent $500 million.
Exactly. They went over the announced authorization by $100 million.
That sends a pretty strong message, doesn't it? Like
Yeah.
management really thought the stock was cheap.
It's a very bullish signal, yes. A statement of conviction that the shares were undervalued at those prices. Actions speak louder than words.
Definitely.
Yeah.
So you have the ongoing settlement program taking care of 40% plus this big buyback. What was the combined effect on dilution in Q3?
The result was pretty dramatic. Jetta stated that Q3 total dilution was under 30 basis points.
Under 30 basis points. Is that
That's
good?
incredibly good. He called it the lowest dilution they've seen in any quarter.
Lowest never. Okay, so the strategy is clearly working in the short term. For you listening, that's a key metric. Are they growing without just printing more shares? Q3 says yes.
Absolutely. It shows the combination is really effective at protecting shareholder value right now.
But what's the long game here? What's the ultimate target for dilution?
The big goal, the aspiration, is to offset 100% of share dilution over time.
100%. Zero net dilution. That sounds almost impossible for a company like this.
It's incredibly ambitious, but, and this is important, the CFO said he sees a line of sight to achieving that goal.
Line of sight? That's specific language. It implies it's not just a dream. They actually have a plan or a model that shows it's achievable based on current trends.
That's usually what it means, yes.
Yes.
It suggests that based on their cash flow projections and planned spending, they believe they're on a path that could eventually lead to zero net dilution.
If they ever got there, that would fundamentally change how you value the company, wouldn't it?
Completely. Every dollar of profit growth would flow directly to a stable base of shares. No more slicing the pie thinner and thinner. It boosts the value per share significantly.
Okay, so massive focus on efficiency, profitability, using cash to manage dilution. But they still need to invest in the business, right?
Yeah.
Especially the platform side Anthony Wood talks about. Are they just spending more overall?
No, and that was the final key point on capital. Jetta made it clear investments, especially in those platform revenue initiatives, are being funded mainly by reallocating existing capital.
Ah, so shifting money around internally, not just opening the taps wider.
Exactly. It's about optimizing the current budget, Focusing on return on investment for every dollar spent, it reinforces that whole discipline message. Thrift is the rule.
Okay, so let's pull this all together. If we synthesize just Jetta's financial message from that call, what's the big takeaway for you, the listener?
I think the core message is one of transformation. Roku's telling the market, we've graduated. They're moving away from relying on outside cash or heavy dilution to fund themselves.
They've built a self-sustaining engine.
Seems like it. You see it in the first positive operating income since 2021, the record-adjusted EBITDA forecast, and the lowest ever quarterly dilution. It all points to a business that can now fund its own future.
And this shows you how those sometimes dry financial details, the basis points, the settlement programs, are actually what power the growth. Being efficient and cash-rich lets them invest smartly without hurting existing shareholders. It makes for a much stronger company.
For sure. Which leads us to that final thought to chew on. They've clearly shifted gears to controlled, profitable growth. Now, if they actually manage to hit that huge goal, offsetting 100% of dilution while still growing their platform revenue like they plan to, what does that imply for the company's rock-bottom valuation? What's the floor?
And tied to that, how does being CapEx light with billions in the bank change how vulnerable they are? If there's another downturn and more competition, does this financial strength make them fundamentally safer? They're not scrambling anymore.
They're deploying strategically, a very different position.
Definitely something to think about. Thanks for diving deep into Roku's financials with us today.